Welcome to Kitchen Table Finance.
Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic. Real heat wave. I think it's up to
Yeah.
22 degrees today, so
All
we're buried
right.
out of some snow and
It's
living life to the fullest.
about the same temperature here today. Low 20s. Yeah.
See, you tried to get away from the snow, Dave, and it
I
just didn't
know.
work
I
out.
know. But tomorrow is Saturday and the high is supposed to be in the mid 50s. And I am going to go on
Wow.
a long hike in the mountains in my t-shirt.
I love it. And kind of continuing our series about the markets here in January,
Yeah.
one of the things that as financial advisors, we are always in the back of our mind, somewhat fearful, worried about is when things are too good, that usually means that the bad times will follow, right?
can't always be good. We know that. It seems to be front and center on a lot of client minds. Like, okay, we've
Mm-hmm.
had 2 really good years in a row. It can't keep going on like this.
Yeah. Well,
Yeah.
that's like the ultimate difficult and why, you can never time the market because really it could keep going on.
Yeah. Yeah.
Right? Like you don't know when it's going to
Right.
stop. So
Right.
it will.
Right. Well, bull markets don't die of old age, I think is one of those old cliches that I
There you
should
go.
know who said that originally.
You actually wrote a piece recently for the Retirement Daily titled Lifeboat Drills, kind of on this concept of, hey, when things are really good, you still got to
Yeah.
check your lifeboat and make sure you understand what to do when the seas turn angry, if you
Right.
will, right?
Right. Yeah. It's not time to do the lifeboat drills when you've hit the iceberg. The time to think about it has already passed. So,
Yeah.
our philosophy is market corrections are going to happen just like storms on the ocean. We're not going to have smooth sailing forever. And
Right.
so, we need to mentally prepare ourselves and our clients for what might come and be ready for it because just like a fire drill or a lifeboat drill, that mitigates the damage when you get there.
Back when I worked for the bank, there was this training that we did on it was like robbery prevention or something like
Mhm.
that. And so this former police officer was like telling us all these crazy stories and like just basically trying to scare the hell out of us.
Mhm.
And kind of his point at the end was your mind or your body can't go where your mind hasn't already been. So I want
Yeah.
to prepare you to
Right.
to have your
Right.
mind there so that
Right.
if and when it ever happens, your body will follow. It won't be
Right.
in shock, right?
Yes.
And that's kind of
Yeah.
similar to our lifeboat drills of things are really good right now. We hope they continue, but
Yeah.
we also want to prepare you for what this looks like when they don't so that
Yeah.
you don't, your body can follow. You don't make a knee jerk emotional reaction and make things worse, right?
Right. Because you're gonna want to take action and you're gonna want us to take action. The actions you want to take, if left to your own devices, will feel right in the moment, but they'll
Yeah.
be not good for you in the future.
Yeah, exactly.
Yeah.
And one of the, I always tell young, aspiring financial planners about is like, yeah, 2008 was terrible, but I'm really glad I went through it because I
Right.
got to see exactly what happens when you stick to the plan and exactly
Right.
what happens when you get out and go into cash.
Yeah.
And
Yeah.
that was, a memory, a
Yeah.
time in my life that I'm forever grateful
Right.
for because it taught me a lot of lessons. And so, actually, interestingly enough, I think you and Cole are going to do an episode on that, just kind of
Mhm.
walking through
Yep.
that next week. So, look forward
Yep.
to that.
Yep.
But it's just one of those things where having these conversations when things are good make a lot of sense. And we're doing it in a lot of
Right.
client meetings right now because there are some things that you need to mentally prepare for, but there's also some opportunities as well. So,
Exactly. So we kind of group things into two parts when we talk about this from our standpoint as advisors. And the first is ongoing strategies, right?
yep.
What do we do every day,
Mm-hmm.
every quarter, even when times are good that are meant to control damage when things are bad? And the first and most obvious is we maintain diversified portfolios for our clients
Yep.
include the whole spectrum of investments, stocks and bonds, geared towards that client's goals and risk tolerance. So make sure your portfolio isn't like built for just the good times. Have the lifeboats on the boat, right?
Yeah.
Be ready to use them when the time comes.
Yeah, and that's always an interesting conversation, especially right now, because there's a lot of like, why do we own this, right? Like
Yeah.
the US stock
Yeah.
market went up
Ugh, yeah.
26% 2 years in a row. Why don't we just buy all that, right?
Yes.
And kind of the whole point of diversification is if it's working properly, there are things that aren't going to perform well when other
Yeah.
things are performing very well. Like
Yeah.
that's the whole
Yeah.
purpose. And it's a
Yeah.
very hard concept to kind of wrap your mind around.
Right. Right. As Michael Kitces is fond of saying, being diversified means always having to say you're sorry for something. Just assume those tough times are going to come without warning. You need to be ready. You need to have a diversified portfolio that matches, that isn't like, oh gosh, stocks are surging, I should be more in stock. Um, that's what's going to get
Mhm.
you in trouble.
Yeah, it's interesting because we just did our market update, and there's always, positive and negative
Yeah.
signals, or I think we're going with glass half full, glass half empty. And
Yeah.
it's interesting because the thing that's really going to throw a wrench in it is the thing that's not on that page,
Right.
right?
Right.
Like it's the thing we
Right.
haven't thought
Right.
about.
Yeah. It's not going to be the thing you see coming. That's
Yeah,
that's part of how markets work. If we can see it
right.
coming, it's already built into the prices that we're dealing with.
Exactly. Yeah.
Yeah. The other thing we do in our portfolios is we really lean into value investing in the first place.
Hmm.
That provides some protection against bubbles
Right.
when we see sectors of the market really take off and become expensive when we talk about what their prices are compared to their earnings. Our
Hmm.
portfolios focus more on value investing, stocks that
Yep.
have lower prices compared to their earnings, and that
Hmm.
means they have not bubbled yet for the
Right.
most part.
Yeah, it's kind of twofold in that they've got further to go up with their,
Hmm.
with lower price compared to earnings, but they have less to go down as well
Right,
because they're already
right,
kind of beaten down to some degree, right? Hence the value.
right, right. And a lot of those stocks also are dividend payers
Right.
more than growth companies. So you
Hmm.
you also have that little bit of income coming in from those stocks too that helps cushion the blow when there's price volatility. If your portfolio leans more into growth, you may want to consider rethinking that a little bit in terms of what types of stock you own, not just how much in stock in the portfolio.
Yeah, which kind of leans into our next point here about portfolio rebalancing.
Hmm.
Because if you're not rebalancing, chances are you are a lot more growthy right now
Right.
because growth
Yeah.
is what's kind
Yeah.
of taken off.
Yeah, and our portfolios don't avoid growth stocks. We just don't
Right.
we don't lean into them as much. And so yeah, the last 2 years it's been a growth stock story where your big tech companies have really driven it. So if you're not going in and taking your allocation back to your targets, you're basically going to see one sector of the market go up and then back down. But if you're going
Yeah.
in and rebalancing, you're taking those profits on the things that have done well. And again, back to always having to say you're sorry, there's things in your portfolio, if you're diversified, that haven't looked as good. That's what you're buying because when it cycles back the other way, that's going to pay off.
Yeah, and no greater example of this than 2008 when a lot of people heading into retirement maybe started off with a 60-40 portfolio, never rebalanced, and
Hmm.
10 years later that were like a 80-85% equity, and then the market dropped 40
And all of a
50%.
sudden they were back to 60% again.
Yeah,
Right. But
and
they
not in
but
a
they
good
didn't
way.
get to right. They didn't get to compound any of that.
Yeah,
So
yeah.
so make sure you're rebalancing. We've talked about different rebalancing strategies before. We do our managed portfolios quarterly. If you're handling these yourself, do it at least annually. There's no magic answer, but at least be going in regularly and adjusting things back to your targets.
Yeah, and
Be
especially for
intentional about it.
our investors that are in 401ks, 403bs, if you do have an allocation, it's pretty easy to set the one-time annual rebalance button and
Right,
forget it, and it will just
right,
automatically rebalance for you. So
right.
this next one is kind of one I know this is harping back to our friend Christine Benz, a strategy
Mhm,
that she really likes, and that is raising cash levels and maintaining contingency funds, and even going as far as having a set amount of cash set aside that you intend on spending in the next couple
mhm.
of years. And I like it from the standpoint of, is it going to give you the best return? No, but psychologically, having
Yeah,
that cash set aside, knowing that if things go bad, you can pull out of your cash for a couple of years and let it come back, is a
Right.
big win for a lot of people that tend to worry a little bit more about volatility.
Right. You don't want to have to be raising cash in the middle of a bear market or a market correction. It's part of diversification in a way. It's not
Mm-hmm.
going to, although when the market is booming, interest rates tend to be higher as well,
Right.
so your yield on your cash isn't probably horrible, and it's been pretty good the last, relatively good the last 2 years.
Yeah.
We're still at 4% on a lot of money markets right now. So, you want to at least be keeping pace with inflation with that money,
Right.
but you need some money that's not at risk.
Yeah, it's interesting. We've had a couple of client conversations around having some extra cash because they have distributions coming up, and it's nice
Hmm.
because, you know, if we're wrong and the market doesn't go down, right, then we
Yeah.
can just pull it out of the investments and sell at a high. And if the
Yeah.
market does go down, we have that protection built in, so it kind of
Yeah.
gives us some options where
Yep.
we don't necessarily have it if we are all invested. And the other thing too is, like you said, like that difference, that spread between what you can earn in a portfolio and what you're earning in cash isn't as big as it used to be in the
Right.
the last 10 or 15 years, because you're getting around 4, like you said, in cash. And so it's not like you're only getting 0.5% on some of that cash as it used to be. So
Yeah.
some good timing, some good things to think about, especially as you head into retirement. Like, what are our major spending needs? Should we set some aside in cash as kind of a contingency, even if it's in our IRA or qualified account?
Right. And I guess our last point on this group of strategies is to have that conversation with yourself ongoing.
Mm-hmm.
Discuss that, think about how that's going to change over time. Don't just set it and forget it, spend the money, and then all of a sudden you're,
Right.
stuck. Those are kind of the ongoing things that we
Mm-hmm.
do on a daily, monthly, quarterly basis with clients.
Yeah,
And you
before
should,
we move on, Dave, I wanted to go back to we kind of glossed over a little bit, but that is the risk reward trade off.
oh, yeah,
And I think that's
yeah,
an important one too, because a lot of times that whole
yeah,
risk tolerance changes. And
yeah,
so it's a good time to, review that every couple years or so. And I also like to think of it in terms of like, what's enough in your portfolio. And part of the problem that we see right now is people start to get greedy when the market goes up 26%
yeah,
2 years in a row, and they
yeah,
start wondering, like, my diversified portfolio only went up 13, right? And like
yeah,
bringing it back to this whole idea of like, what are you trying to accomplish with your portfolio? What kind of return do you need over the long
right,
term? And
yeah,
what kind of risk are you willing to get it? Really helps kind of have that conversation of getting people away from becoming riskier, right?
yes,
And following more of Warren Buffett's be fearful when others are greedy and greedy
yeah,
when others are fearful,
yeah.
right?
Yeah, you don't want to like look around and say, "Well, gosh, I wish I'd had that money in the market. I'm going to put
Right.
that money in the market now." If you
Mm-hmm.
had, it's one thing to sit down and have like a rational discussion about your long-term needs in that regard, but don't make it about what the market's been doing, because
Right.
that's going to get you in trouble.
Yeah,
Yeah.
absolutely.
What do we do during a correction?
This is an interesting one because there are some opportunities or things
Mhm.
that you should be thinking about when markets do go down.
One of our favorite things and what we talk with a lot of clients about is Roth conversions, essentially moving money from traditional IRAs to Roth IRAs when opportunities arise, when you're in a tax situation where you may be in a higher tax bracket in the future, or depending on what your legacy goals are, that may be a good strategy. Well, your tax budget maybe tells you can move $10,000 this year,
Hmm.
from traditional IRA to Roth IRA, or 40,000 or whatever that number is for you. If you do that during a market correction and the recovery happens afterwards, because the
Hmm.
recovery will happen, right?
Right.
And so if you move that 10,000 or 20,000 or whatever your tax budget makes sense into the Roth before the correction, and it recovers in the correction, you've gotten more bang for your tax buck, right?
Right.
When we have those conversations with clients in the early part of the year, it's usually like, hey, before the end of the year, we should do this. We'll probably do it at the end of the year if the market keeps doing what it's doing. But if we see it, we may call you in June if
Right.
the time is right.
It's always kind of a tricky thing in terms of, I'm sure our listeners have heard us several times on here saying, don't try to time the market.
Right.
And we never do. But in terms of being opportunistic with Roth conversions, yes, it's a little bit of timing the market, but it's more of like, hey, and it's not like, hey, we're going to wait until we get to the exact bottom. It's like, here's an opportunity. We're going to do this anyways. It makes a little bit more sense to do it now.
To take the next step on that, we're not talking about like getting out of the stock market. We're talking about moving. We have to sell and buy, but we're going apples to apples usually, or sometimes we're going more into stock in the Roth.
Yeah,
Because
good
when
point.
we talk to clients about how they're going to use their Roth, when do you spend your Roth? For most people, it's the last money they're going to spend. So your time horizon is longer. So a lot of people can stomach more volatility in their Roth.
Yeah, no, that's a
So
great point.
sometimes we're doubling down on the fact that it's, been a lousy market. We're not really timing it, like we're not trying to get it perfect.
Right.
But it's an easier decision to make. Hey, the market's
For
down.
sure.
Let's go ahead and do it. And while we're at it, let's go, 70% in stock instead of 60%. That's a great way to take advantage of a down market.
Absolutely. Yep. Oh, great point, Dave. So the next one on our list is tax loss harvesting. You want to kind of walk us through the thought there?
So when the market gives you lemons, you can try to make some lemonade, right? Tax loss harvesting in a non-retirement account. When you sell a stock at a gain, you pay capital gains in an after-tax account. When you sell a stock at a loss, you can use that loss to offset gains on other investments, or you can use some of it every year to offset income, and you can carry that over. There's a lot of different ways we can use this depending on the client scenario. If you sell a stock or a fund that is down, capture that loss and invest the proceeds in something similar, you haven't really changed your asset allocation. You've just captured that loss for tax purposes.
Right.
So there are some rules around it. It has to be different enough for the IRS to not disallow you to claim the loss. But that's pretty broad, and your advisor can work with you on that. The other way we use it is a lot of times we'll have clients with legacy portfolios where maybe they've held them for a long time. They're no longer quite suitable, but it is hard to get rid of it because the tax cost is high. Well, the tax cost is lower when the market's down.
Yeah.
So, or when we have losses on other things to offset those gains.
Yep.
We're not, again, trying to time the market or change the asset allocation. We're just trying to improve the vehicles within it at a lower tax cost.
Yeah, no, absolutely. There's lots of thought and math that goes into that, but for a lot of people, it makes sense just from the the pure standpoint of thinking about it in terms of harvesting some losses that you can offset taxes with, but also, like you said, repositioning portfolios. So there's a lot to potentially do there and a lot to look at.
Yeah.
The next one on our list is dollar cost averaging. You want to talk a little bit about how we use that strategy, Dave?
So if you do have the ability to be investing instead of withdrawing from the markets, during a down market, obviously the opportunity is better. We get a lot of questions about, well, is this the bottom? Is it going to keep going down from here? We never know, right? You never know where the bottom is going to be just as hard to call as the top. So dollar cost averaging, committing a certain amount every month or every quarter on a schedule that suits you, takes some of that risk out and some of that question, but gets the money to work.
Yeah, it's. I remember in 2008 had a couple of clients actually, who their company was actually doing pretty well, and they, I used to call them every week after like a really bad week in the market and be like, "Hey, you guys want to put some money in?" Sure enough, every time the funny thing, and then not so funny at the time, I guess, is every week it just kind of kept getting worse. And so, we just, they had a chunk of money they wanted to put in. And so we just waited for some opportune times to put it in and got most of it in. And we didn't like play around with wait for the bottom, but we took our opportunities when they came, and it worked out really well for them in the long run for sure.
The last point on here, review your income needs and sources. Sounds like what we were talking about before, but in this context, if you're taking distributions from your portfolio and things are really getting ugly, think about at what point do you cut back on your spending? What can you put off for 6 months or a year if it means taking money out of the market? And you should be doing that ongoing, as part of your regular budgeting and maintenance anyway.
Yeah, I think that's a great point. And kind of, I like the idea of, we've been doing a lot of this in client reviews right now, of like thinking through what does my portfolio have to go down to before I need to make some
Right.
changes in my income, and
Right.
how much of a change do I need to make, and what does it need to go back to before I can readjust that upwards. And I think that's a really healthy discussion to think through when things are going well, because it really kind of takes some ease out of on people's minds in terms of understanding like what the ramifications of a bad market is and how it relates to their portfolio.
Well, yeah, and I think we've both talked about this in as our experience from the great financial crisis was that while, like, if you ask somebody today what they can cut from their budget, they're not going to be real open to the idea. I remember that being just a common theme of, well, we're just going to wait to buy a car. We're just going to, we're not going to take that vacation. Oh, are you kidding? We're not taking that money out of our portfolio. And sometimes it maybe wouldn't have been a big deal, but that tends to be the psychology from investors during that time. In a good way. Nobody likes to have to cut their spending, but at least in an extreme example like the great financial crisis, I think I saw this with clients that I talked to during the COVID crash too. Well, we'll talk about that when that was a little different because you couldn't do anything anyway. We don't know when we're going to be able to travel. I can't even go to the car dealership to take a test drive right now. So it was a little bit different. But during the great financial crisis, the ironic thing though too is a lot of time. Well, and I guess these go together. Then the financing is a lot cheaper too during those. Like if you're going to buy a car, maybe you make a smaller down payment and finance more because the interest rates are going to be lower too. So there's a lot going on there, but just be ready and realistic about how you spend and what you need to spend versus what's discretionary money that you could put off a little bit.
Yeah, it is pretty remarkable how adaptable most of us are as humans, right? Like I remember in college having no money and having one of the best times of my life on ramen noodles and cheap beer, right? Do I want to go back there? No.
The old electric wire spool that you used as a table. Cinder blocks holding your stereo. Yeah,
exactly. Do I want to go back there? No. Could I? Maybe. if push came to shove. Right. So but I think that's a good point of like just mentally going through that and thinking about it as a good exercise for people. So.
There's a Latin phrase from philosophy for that, and I should have it at the tip of my tongue, but it has to do with imagining the worst circumstances so that when you get there, it's not a surprise.
Well, I think that wraps it up for our lifeboat drills. I hope our listeners found this useful. If you have something that you personally do and would like to share with us, we'd love to hear it. Send us an email at info@srbadvisors.com. And we here at SRB are going to keep doing lifeboat drills, but hoping for the best when it comes to the market. With that, Dave, until next time, my friend.
Take care, Nick.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.
This is a Zedia Media production.